Thank you. And thank you to those who are staying with us to the end. I know it's been a long day, but we are near the finish line and near you being able to have some drinks. So just to introduce myself, I'm Emma McGarthy. I head the Sustainable Policy Institute here at OMFIF. So we are going to now be discussing how we can crowd private finance into emerging markets and the role of multilaterals and blended finance. So I am joined by some fantastic panelists. Thomas Venon, who is Executive Director of the Centre for Development Finance Studies and is representing Mobilis today, which we'll hear a little bit more about in a moment. Carsten Mueller, who is a Regional Industry Director of Manufacturing, Agribusiness Services in Asia for the International Financial Corporation. Leslie Maasdorp, who is Vice President and Chief Financial Officer at the New Development Bank. And Joachim van Amsberg, who is Special Advisor and the President, Special Advisor to the President of the Asia Infrastructure Investment Bank. So thank you all very much for joining me. So we've talked a lot today, obviously, about how the role of investors. We've had a shout out from Leong Wei Leng already about the importance of blended finance in crowding in money into developing nations. So what we want to discuss today is how we can improve public, private and blended finance and the key elements needed to crowd financing into emerging markets. So I'd like to start this with a question, firstly, to our MDB representatives. And what role do MDBs play in this? And Carsten, I'll go to you first. Thank you.
Thank you. It is on. Good. So so I work for IFC. IFC is part of the World Bank Group, and we are owned similarly to the World Bank by our member governments, about 180 of them. And I'm mentioning that is because I think a lot about crowding in capital is risk mitigation. And the reason we are typically in demand for is we have sort of quasi-political risk cover. It's not a per se guarantee, but we have, because of our link through the World Bank and directly with governments, can help resolve difficult situations. That's a bit sort of the starting point. What we like to play often is an honest broker role that is between the different investors, stakeholders of the investments that we do, and if needed, the government as well. I would say another key role why we're often in demand is we're a standard setter. That sometimes we can be a bit demanding when we take a look at projects, but we've done that in setting standards for environmental and social, which are followed by many other MDBs or DFIs. Similarly, we've sort of defined what impact investing is about and do this in cooperation with others. And the same thing goes for what we're going to be probably touching on later on about blended finance, setting standards to see that we're roughly playing on an equal playing field. Let me also say by decarbonization for us is a key theme. So I cover sectors, manufacturing, agribusiness and services. Particularly in manufacturing, whatever have to do with buildings, we take a very close look how we can help clients transition towards more client-friendly production or doing buildings, running buildings. But it also goes into agribusiness and trying to find less climate impact on producing feed and producing animal protein. So it really goes throughout. It's a transition finance, as sort of the headline, is a key topic for us. What we do is we have a variety of investment instruments from debt, equity, mezzanine in between. We shifted towards also short-term finance, which we can do nowadays. And we can play a major role in crowding in others, which was one of the questions. So mobilization, and I can talk a bit more later about that, how we do that. We have various avenues where we do that in conjunction often with our peers. And one way, if things get really challenging, is also blended finance. Let me stop here.
Thank you, Carsten. I like the term of you being an honest broker. Maybe we can come back to what that means. Leslie, over to you for the same question and the role that MDBs play in crowding in finance to emerging markets.
Thank you very much, Emma. And Carsten's already set the scene by situating the IFC within that domain. The IFC, of course, is very important because it is 100% focused on the private sector, whereas most of the rest of us, the multilateral banks, have been focused on sovereign loans, been focused on state-owned enterprises, on utilities. So the largest part of our book have been focused on lending to and investing in infrastructure where they are sovereign guarantees. In the case of the New Development Bank, We have at the moment a 90-10 split, meaning 90% of our total loan book of $35 billion of approved loans, only 10% have been to the private sector. The direction of travel for all MDBs is towards increasing the size and scope of our private sector exposure. Secondly, mobilization of private sector capital is the #1 institutional priority for all of our institutions today. In other words, there's been a complete shift away from a business model that was focused on lending and growing our own balance sheet, whereas now it's about using our balance sheet and using our financial instruments in a creative and catalytic way to crowd in private sector capital, as Carsten have just said. So the key point now is, what are the financial instruments and the way in which we can do that most successfully? Now, this is not a new journey. I would say this journey started about roughly, I'd say 2015 or so, almost more than 8 years ago, where this bigger focus on the role of the private sector was emphasized in the Finance for Development Global Conference that took place in Addis Ababa in 2015. But somehow we have not reached the scale yet. So blended finance have been deployed by the IFC and many other multilaterals, but it has not reached kind of industrial scale. So what we're faced with now is to look at what are the obstacles, what are the barriers, why we've not succeeded in doing that. In short, what we are saying is that our big focus now is on de-risking, is about using our very high credit worthiness, using the fact that we are AAA and AA plus type institutions in such a way that we can take on the risks that the private sector and institutional investors are not willing to take. So we want to become big de-risking machines, if you like, and we will, going forward, not be as risk averse as we have been in the past. That is the mandate from our shareholders, and it's underpinned by a recent G20 report, which was endorsed at the Marrakesh annual meetings of the World Bank about 2 weeks ago. In short, what I'm saying is that, and we'll talk about this later again, there are fundamental changes happening in our world of development finance, and we will become the leading catalytic institutions to crowd in more private sector capital. Thank you.
Thank you. I'm very much looking forward to hearing a little bit more about what this looks like. Joachim, again, over to you for the same question. The role of MDBs. I appreciate we've already had comments, but yeah, things that you would add to that.
Oh, thanks, Emma. And AIIB, the Asian Infrastructure Investment Bank, is one of the new MDBs set up specifically to finance infrastructure in developing emerging countries. So my comments are very much focused on the infrastructure sectors, which of course resonates with the theme, because depending on how you count, 60, 80% or even more of emissions are actually directly related to infrastructure, energy, transport, urban, and so on. I mean, private investment doesn't come because the UN conference or the G20 instructs them to invest. It's pretty obvious to all of us here, but I think it's quite important to ask, what drives investment? It's, of course, opportunities to invest and get a return that's commensurate for the risks. So what holds it back? And what explains what I would call the sort of infrastructure finance gap? These discussions about trillions of dollars of investment needed for transition finance on the one hand, and then the very meager actual private investment flows into emerging country, developing country infrastructure. First, it's a policy environment, it's a policy setting. We touched about that in the previous 2 sessions. The policy environment, for example, the lack of existence of carbon pricing, carbon markets, sets the incentives and means that there isn't a priori a return to investments in transition that would be there if we had carbon pricing, carbon markets in place. On the risk side, in many emerging countries, you have an investment climate that is deterring investment because it creates high risks, political risk, regulatory risks that keep investors from investing. So you have sort of the one big bucket, which is the policy obstacles or the policy environment. Then you have just the project side. Infrastructure is complicated, it's physical, it's big. It involves people on land, people who have their houses on land that people want to build something on. So it is complex, requires coordination between very many different actors. It's different from manufacturing, where you can just set up a plant from scratch. So infrastructure is inherently complex, in particular in a weak institutional environment. So it just takes a lot of work to bring many partners together to create high-quality infrastructure projects. And without projects, there is no investment. And then there's a financial side, which is probably the easiest to solve. And yet, I think innovations are necessary to bring finance at scale to infrastructure. Whether that's some of the securitization platforms that colleagues here in the room are quite familiar with and involved with, that we're partnering with very proudly, or some of the other mechanisms that are attempting to bring infrastructure finance to scale, I think those are very important. So these are the obstacles. What do MDBs do? And very similar, that's why I can be brief, to IFC or NDB. We are essentially doing three things. We're providing finance, project finance, for infrastructure projects, that is longer tenor, and willing to go into riskier markets than pure commercial financiers. We provide technical support. This comes to the side of project preparation, how to actually technically prepare and put resources into preparing good projects. And then Carsten called it honest broker. I would call it trusted partner. And I think it's absolutely essential in infrastructure. Because infrastructure contracts are typically quite incomplete because of the complexity of the sector. So the partners who are coming together, government, private sector, investors, sponsors, need to trust each other. And then when you have a multilateral in the mix, whose owner includes the government, it creates the basis for the trust that is necessary for moving forward in this imperfect world of imperfect information and incomplete contracts, so that investors know that governments will live up to its commitments, convert foreign exchange, live up to concession contracts, but also the other way around, create the trust that the private companies deliver what they have committed to deliver. For example, in terms of environmental social standards, again, where the multilateral, I think, can build a lot of trust between the parties and make projects happen that otherwise just wouldn't happen.
Thank you, Joachim. Yeah, so we have trusted partner and honest broker. Very good. Thomas, so you are the non-multilateral on the panel, so no pressure. You represent Mobilis, as I said. So Mobilis is a government program which is aiming to build momentum for investment in emerging markets at scale. And obviously for blended finance, to do this, we need the public participation as well. So this is what you'll be bringing. Could you give us a quick introduction to Mobilis and how are you supporting MDBs in crowding finance?
I will try and be short.
Of course.
So first, as you rightly identified, so Mobilist is a flagship program of the United Kingdom's government, more specifically of the Foreign, Commonwealth and Development Office, or FCDO for short. I'll use the short version from now on if that's all right. And it is a development finance program, so maybe it's useful to remember that the UK government is active in development finance in a number of ways. It is, of course, a shareholder of 2 out of 3 multilateral development banks represented by my learned colleagues. It is the sole owner of the bilateral DFI, British International Investment. It is a very significant contributor to the Private Infrastructure Development Group, or PIDG. And then there's Mobilist. And I guess a very different aspect is, first of all, that Mobilist is a program, not an institution that has implications for the way we work. And so Mobilist is articulated around 3 concepts. The first one is, it is a mobilization program, as the name kind of suggests. And the first concept is that the program seeks to meet investors where they are, and where investors are, or at least where the overwhelming majority of their capital is on public markets. So it's invested in stocks and in bonds, 97%, don't kill me if it's 96. But that's where we think the scale that Leslie was referring to can be found. That doesn't mean that no work is necessary on the 3%, but that's private markets are where a lot of emphasis of mobilization initiatives by MDBs, bilateral DFIs and others has been, and therefore Mobilist is trying to address that by focusing on public markets. The second concept is to recognize that capital markets scale through replication. Right, you don't scale $1 trillion fund at a time. You just let the market do what it does best, which is copy and paste. And therefore, the objective of Mobilist is to create precedents to help instruments get on public markets that are instruments that are, of course, in line with the sustainable development objectives of FCDO, and demonstrate that they are effective at what they seek to do, and again, allow the market to scale through replication. So what we do as a program is seek to identify opportunities on their way to public markets and help them get across the line. And the third concept there is that to recognize that a lot of people have spent a lot of time and great deals of money building capital markets infrastructure, and therefore, rather than reinvent the wheel, the way we run the program is by leveraging of existing capital market infrastructure. So we have struck partnerships with stock exchanges, in particular with the SGX, a partnership that we are very grateful for, and that has already borne fruits. Through these exchanges, we reach out to the intermediaries, the investment banks, the brokers that are the gatekeepers to public markets, and they in turn bring opportunities to our attention. So they're both our ears and eyes on the ground, but also a first filter, because they're usually quite careful about what they dedicate their resources to. And that's modus operandi is based on alignment of interests, right? Stock exchanges want to grow the universe of instruments on their platforms. They want to grow the volume of trading on their platforms. So do we, insofar as these instruments are aligned with sustainable development objectives. Equally, investment banks, brokers are, of course, incentivized to help listings, and we want to work with them. So what can we do once we have identified opportunities? Three things. The first one, and potentially the most exciting, is providing equity capital. Very important to note that it is not concessionary in nature. We can invest where others don't, but this is not a concessionary pool of capital. So we're happy to be large, we're happy to be visible. We can't be a majority for obvious consolidation reasons, and we can adopt an underwriting approach, as in the idea is to provide just what issuers need to get products across the line. We provide technical assistance funding, so grant funding, to essentially share in the risk of doing the right thing, of doing the public thing. And finally, we can also bring to the party what we refer to as the convening power of the UK government, which can, of course, provide a great deal of visibility on markets, which, remembering my long fundraising years, is no bad thing. Was that short enough?
It was short enough. Very good, thank you. Leslie, I wanted to go back to your comments on the reform agenda that has been set for MDBs and the roadmap that has been established to support this. So could you talk me through that? And also the role that MDBs should be playing in generating and deploying capital. I think perhaps even tying into that, we can touch upon the audience question that we've had, which is whether MDBs should be paying for the transition and what that looks like. So yeah, over to you. There's quite a few things there, but
So thanks very much. I'd like to start off by saying that the current sort of MDB reform agenda has been in the making for a number of years. So what we see now is very much the sort of synthesis or the sort of combination of work that has been taking place at least over the last decade or so. I'd say the first major element is a move away from the way we conduct business, which is, originate loans and hold it on our books to maturity, which is really a very conservative approach in many respects, because, once let's say a solar project, once the project is built, there's no more construction risk. Once a project generates predictable returns, there is an ability to offload those projects, to sell those assets, and free up lending headroom for you to do additional more lending. So moving away from this originate and hold model to originate and distribute. The second major sort of change and shift is also MDBs functioning more as a system. We functioned before as individual enterprises, all very protective of our very high credit ratings, but we've never leveraged off the system and create, if you like, portfolio approaches. For example, IFC have something called MCPP, the Managed Co-Lending Portfolio Program, but it's a very much an IFC platform. we could use some of those portfolio approaches across the MDBs as a system. In order to do that, though, we need to harmonize our approaches to, for example, ESG, our approaches to procurement, standardized loan pricing, and a whole range of other areas where how we assess development impact, for example. So AIIB's approaches will be slightly different to ours, different to European Investment Bank, and so on. There is no need for us to have such highly sort of specified approaches to in each of our institutions. So a couple of weeks ago at the annual meeting, the World Bank launched, a new World Bank president unveiled a new initiative for the World Bank to drive this agenda for us to function more as a system. A third major area which we already touched on is us to be more catalytic. So we won't just invest in a solar project. We'll want to be building a solar park so that we use our capital in such a way that it has a multiplier effect. We are also re-looking at our capital adequacy metrics because we have been very conservative in the way that we do our capital provisioning. So the credit rating agencies we have engaged with them over the last year and a half or so, and there's a much greater understanding now that both the rating agencies and ourselves have been too conservative in the way we set those models. Fourthly, we are also now looking at hybrid capital, which is a new financial instrument that we have not deployed in our. We essentially have a capital structure as MDBs that is paid in capital or equity, and then we have something called callable capital, which is a form of a guarantee. We are now looking at new financial instruments or new classes of shares like hybrid capital, where we can bring private shareholders into the very structure of MDBs. We already touched on this whole focus on de-risking, and as Joachim have said, it's about making sure we can create a risk-return profile of a project or a series of projects that makes it attractive for institutional investors to co-invest alongside us. We're also doing a lot more local currency financing, which, as you know, projects can be much more sustainable, because if the revenue of a project is in local currency and the country is borrowing in dollars, there's inherent FX risk involved. So we want to have a match between the asset and liability and do a lot more local currency financing. Finally, also making greater use of concessionality, because a lot of middle-income countries, they can no longer have access to concessional funds because of the way the graduation model work. But if you want to reach scale in terms of moving towards net zero, we need to deal and manage, especially countries like China, which contributes 27% of global greenhouse gas emissions, India, and these very large emerging markets. We don't have access to the concessional funds, but we need to find a way to relook at that sort of graduation model. And then finally, as I already mentioned, sustainability is now hard-coded in the business model. So 2 weeks ago in the World Bank annual meetings, it was pretty much endorsed that the climate agenda or climate will be incorporated into the formal mission of the institution, which before was poverty alleviation and boosting shared prosperity. This might seem like a small thing, but what it does, it elevates sustainability to the #1 priority within our institutions. In short, what I'm saying is that there's a reform agenda that will take a long time to execute, but the direction is towards us functioning differently, making better use of our capacity to de-risk and to bring in the substantial volumes of private capital that is trapped in savings that is within the insurance industry, asset managers, and so on. Thank you.
Thank you. I wanted to go back to the point on de-risking, because we also had a question on MDBs becoming de-risking machines and the role that might have on your AAA. Would any of you like to take this? Carsten, Joachim, would one of you like to respond? Do you have any thoughts on this? Joachim, you look ready. Go for it.
Yeah, because I think it's quite, on the de-risking, I think it's quite important to distinguish the appropriate allocation of risks from the reduction of risk. And really start by saying the best way to get investments going is to reduce risks, where in particular governments have the ability to actually reduce risks. And that has to do with regulatory uncertainty, rule of law, the quality of contracts for energy projects, for example, the quality of power purchase agreements and the like. So there are many actions governments can take to actually reduce the risk for the investors. that is slightly different from the often sort of slightly different notion of sort of shifting the risks around and either asking the MDBs to just take the risk or to pay somebody else to take the risk. And yes, I think MDBs can and should take some of the residual risks once the project really, the sort of intrinsic risk of the project has been reduced as much as possible. But I think it's always important to ask which is the party that is best placed to take on those risks. It does not make sense for the government to be the originator of some of those risks and then pay somebody else through higher expected rates of return to carry that risk. And that's unfortunately happened a lot in privatizations in the recent past, where they get sometimes a bad name. So yes, I think MDBs can become a de-risking machine by first helping governments reduce risk, and secondly, taking on risk in a smart way. I mean, there are good examples I mentioned earlier, how public institutions, MDBs included, can take equity risk in certain structures where private investors would not go in. And thereby actually bring about the kind of leveraging that we talk about in terms of blended financing, of actually bringing in private investment at scale. I think in particular the equity instruments of MDBs or sometimes public institutions, like the Singaporean government, which is taking equity stake in certain developmental initiatives in a very effective way. I think that's a good way of leveraging.
Thank you. Carsten, anything to add to that?
I mean, Joachim was quite comprehensive. What I would say is, I mean, the main role in my mind of an MDB is, and we have a private sector focus only, is to go through this risk allocation exercise as Joachim was referring to. So who's best to carry it? I would agree with Joachim, there may be residual risk, and this is where MDB comes in that we can carry. We're getting questions here about our AAA rating, but we need to, I'm mentioning that because we need to balance that against retaining that rating, which is important for us to access the most affordable funds to on-lend them or to keep investing them. So that's why we sometimes refer to and use what we call concessional finance and come up with a blended finance model. Occasionally, we do this only for the really risky markets or for projects where there is sort of a residual risk that is very difficult for anybody to carry. And luckily, we have access to funds. They come either often from governments, from philanthropy, and similar like organizations to carry this out. So yes, answer in short was yes, and there are tools to do that.
There's one other small point I wanted to add, which I should have right at the beginning. It's a very basic point, but I should highlight it. I think MDBs in general, if you speak to institutional investors, they will say there's a real hassle factor in dealing with us because we can be quite bureaucratic, slow moving, take forever. So speed of execution is a big focus also going forward. You know, it can take sometimes up to 2 years for a project from concept note to board approval for a big mega infrastructure project. There's no reason why we should take it should take that long. So we are also now, you know, want to make better use of technology. Just look at all the different ways in which we can sort of inject speed into that process so that we can be more aligned with how the private sector operates. You know, you can't take a year to get a project before you even disburse, just from the identification to approval.
No, thank you. I'd like to take it to blended finance now, and the role that blended finance plays in mobilizing investment and infrastructure development. So what government policies and frameworks are needed to support this, and how do MDBs support this? Joachim, maybe I can go to you first for this one.
So Leslie referred to the 2015 Finance for Development Conference. At that time, sort of the MDBs framed this or coined this phrase, billions to trillions. The naive idea, as some misunderstood it, was to say, well, you need sort of 1 billion of public resources, and then a trillion of private money will just follow. Now, that of course was never really the idea between billions to trillions, because it's, as I said earlier, it's actually very hard to turn money into effective projects on the ground. And I think many people forgot the work that's needed to turn a billion into a trillion, and the work that's needed by governments on the policy framework, the work that's needed by governments, project sponsors on the project preparation, and the work that's needed to put the right financial structures into place. So that's why I think the billion to trillion agenda or the blended finance agenda got a little bit of a bad name, but I think due to a misunderstanding rather than due to an intrinsic fault. And when we talk about blended finance, it means that somebody is putting money in, typically some concessional funding, that is meant to achieve a public policy objective, blended together with commercial with commercial funding. Now, concessional funding is typically scarce. We as MDBs actually have to operate according to sound banking principles, so we don't actually have concessionality ourselves. We typically get concessionality from our shareholders who give us some extra money, or philanthropies, as Carsten mentioned, that give us some concessionality as a bonus, as an additional resource. There are special funds like the Green Climate Fund that many of us tap into to create special incentives for climate-friendly policies. But these funds are, in the end, relatively modest in size compared to the challenge we're dealing with, compared to the scale of, let's say, carbon markets or carbon pricing that would be required. So you have to think very carefully about how to use that very strategically. And you have to look at sort of the investments across the spectrum from, on the one hand, commercially viable investments. There are segments of, let's say, renewable energy investment that are now perfectly commercially viable. When you think about the better developed markets, let's say solar markets in India, you actually have private money competing for those projects and competing down the returns, which is a good thing. But that means you don't want to put concessionality in there because it would be, frankly, wasted resource. On the other hand, you have, at the other end of the spectrum, clearly unviable proposals. And we get those all the time. Fantastic ideas, unproven technologies, no chance that you can get actually commercial money into that. And also there, blended finance concessional money would be waste of resource. So then you end up in the sweet spot, which is sort of the marginally viable, promising, exciting strategic projects. Let's say moving renewable energy into very difficult markets where so far the commercial interest isn't there. Technologies that are sort of on the verge of becoming commercially viable. That's where I think concessional funding, blended finance can have the biggest impact. But it needs to be done very carefully, recognizing that ultimately concessional money is quite scarce and needs to be done, and I think Carsten alluded to that already earlier, in a way that's coordinated and where we as sort of public institutions don't compete each other for the best projects and then waste, in a sense, the very scarce public resource. So back to the billion to trillion agenda, I think it actually has a lot of intrinsic merit, but it has not delivered at scale because the hard work of policymakers and of project developers hasn't really been done yet. So that's the work we all have to do together.
Yeah, absolutely. Thomas, not to put you on the spot slightly, but obviously you're coming from the government perspective. What policies and frameworks do you think are required for this?
So yeah, thinking about the regulatory frameworks, I think is extremely important, as Joachim pointed out earlier. The reality is what we need is to create a level playing field and to make sure that there's regulatory coherence. And that's true between advanced economies and developing countries. And we must keep in mind that many of the regulatory or prudential frameworks were created by advanced economies to solve advanced economies' problem and de facto adopted by the rest of the world. And therefore, we've created these incentives for mobilization, for development finance, unwittingly, to be sure. Also making sure that there's a level playing field and regulatory coherence between public and private markets, for example, to make sure that whatever the level of regulation reporting we think as a society is right, it applies to all aspects of the funding continuum.
No, very good. I wanted to go back to, Joachim, what you were just touching on about blended finance and perhaps some of the critiques. And I did see a question which popped up there as well. So a big critique of blended finance is that there needs to be a huge amount of public investment and strategic allocation from government, which even then attracts minimal private investment in the end. Whilst at the same time, private markets will say there is not enough public capital being deployed. So Carsten, maybe I'll go to you first of all. How do we overcome these barriers? how can we raise the private money which is needed, and what is preventing the private sector from scaling up and investing the capital that is needed to do this?
Yeah, maybe let me take one step back. And I've seen, I think, with our peers as well, we had quite a bit of a debate how to use blended finance. So in IFC's case, we have a pure private sector mandate. So we are held to invest into profitable projects. We have to retain profitability ourselves to be able to access capital markets at a rate. So it was a huge debate for us, and there is the risk that Joachim was alluding to, is a race to the bottom. If we were having access to vast amounts of blended finance, would we be trying to compete against each other in offering the more attractive finance to a project that we all like? So there was a lot of debate on what role we should play. And so what I've decided is we have a very rigorous or selective approach when we use blended finance. And maybe just sort of a couple of criteria that we use when we think about should we apply it to a project. It typically goes into high risk environments. Often is a high country risk, or the sector is still plagued with risk, or we're now increasingly trying to see also how can we look at new approaches. So I've adopted also the project development approach. So quote one example, renewable energy has been pretty well established. Green hydrogen is a huge topic, but it hasn't been really proven to be a scalable, commercially viable undertaking. But there's a potential. So we also have the potential to use some of the blended finance to see, with the right partners, can we come up with a scalable model that works, that can then be replicated in other markets. And in that process, also defining where is the environment right to do, for example, green hydrogen. So this is sort of the environment, the applicability for blended finance. The way we think about it is we apply the same rigor that we would to any project. So we look at, does the MDB IFC have a role to play? Is there enough development impact? And is a concession really needed? And we apply what we call the minimal concessionality standard. And we actually do calculate what the minimum concession should be. There's a whole process thinking about it, what is needed to make it work. The idea is, again, is crowding in others. So at a minimum, it's us and the sponsor of a particular project. And the idea really is that the concession is temporary. We want to move this ideally in the long term into a sustainable market, so the concession will fall away. So the commercial sustainability is a huge criteria that we do look at. We do apply the same standards, ENS, corporate governance, whatever else there is, as we would apply to any other project. Because of the concern that this can lead to a race to the bottom, we're also very transparent. We decided together with the MDBs, we're actually disclosing for each transaction where we use blended finance publicly how much it was and what is the reason why we used it. We did agree with the MDBs also on principles on how to use blended finance. So we do this in concert. And yeah, so we use different channels, I would say, that we have access to. Some come from governments. We have great cooperation with some of the big philanthropy houses in doing so. We've created facilities, particularly for agribusiness, for example, where we can tap that into with multiple donors providing that. So it's a mix of things that we use. They often have their specified focus area, so we apply that a little bit in organization with or in coordination rather, with our donors.
Good, thank you. We've had a question which I think is interesting on, can you describe the demand and supply of funding versus projects? And do we have more funding or do we have more projects? Joachim, you look ready to take it. I'll pass it to you.
It's one of my favorite questions because I spend a lot of time in conferences with investors who are saying, we have all this money and we want to invest and there are no projects. But I spend an equal amount of time in conferences that government organizes. They're saying we have this long book of projects and nobody wants to invest. And both are right, because what they call a project is fundamentally different. An investor is looking for a project that has a well-defined risk-return profile. When you look at some of the government proposals for projects, sometimes it's just 2 lines. It's the name of a valley where one could maybe one day build a hydro plant that could one day maybe generate some electricity. And I think that's what explains the paradox, right? That you have sort of this amount of funding there, you have the big need, and what's missing are the bridges between the two. And by the bridges, I mean money that goes into preparation of projects, efforts that go into the policy context, all the hard work that I mentioned earlier. And that's frankly where the MDBs come in, because we cannot do it alone, but I think our tools are particularly suited for building these bridges between the demand and supply for capital. And that's why I like the question.
Yeah, no, good. Leslie, do you have anything
I
on
just want to add to that. I think and the IFC, in fact, should be credited for having come up with this concept in a much more systematic manner. But the idea that because we finance projects we're involved in transactions, but there's a lot of work required, as Joachim just alluded to, before you get to the stage of financing, for example, a solar project. There needs to be a policy environment that is conducive for investment. There needs to be a regulatory framework which makes it possible for, if it's an independent power producer, for negotiations with a body that's credible, that has track record, so you have an offtake and so on. So it's sometimes necessary for us as multilateral banks to step in and do what the IFC called upstream work, meaning we actually help the governments put in place the policy environments, which increases the probability of the projects, real projects coming that have commercial components, as Joachim have just said, projects that are bankable. So instead of sitting there and waiting for the projects to come and complaining that they are not coming, do some work to create markets, as the IFC calls it, to create the possibility of more transactions. So we had to be more nimble and agile as institutions to not just sit and wait to build our project pipelines from bankable projects that are ready, but actually go out there and be a bit more proactive in working with those governments. And Africa is a good example, the continent where I'm from. We have massive solar, for example, renewable energy potential. We can power, just with one hydro project, Inga, in Africa, we can power the entire continent. But there's conflicts and wars and fragile states in the middle of, that region. So it's never been possible for decades to finance that particular project. Africa, as you might know, have hundreds of millions, more than 400 million people do not have access to sustainable supply of electricity every day. They do have coal, dirty coal under the ground, and they're unable also to finance new coal-fired power stations. So it's a real dilemma. And on top of that, Africa only contributes about 3.8% of greenhouse gas emissions. So we have over 1 billion people. We haven't caused this climate change problem, by the way. The developed world has been more responsible for that. And therefore, this issue about the just transition is a very critical element to introduce into this conversation, because we have to accept that the developed world have a moral and historical culpability for what we are, where we are today. Because when Europe industrialized, and the last 150 years, 200 years of the Industrial Revolution, the price of carbon was not under discussion. So now we are, in a sense, almost slowing down the industrialization of low-income countries, especially countries like Africa and other parts of the world, because of the climate agenda. So this issue of the just transition is a central element that we have to incorporate.
Yeah, no, 100%. Thomas, what's your perspective in terms of the blended finance issues that we've raised? And also there was a question on funding versus projects. And obviously this is a role that I think Mobilis is trying to fill. So what are your thoughts on this? And can you talk me through some of the solutions, the technical assistance that you're providing, and the new products on the market that you're bringing as well?
Yeah, there's quite a few.
Quite a few questions.
Different questions.
Quite a few different questions.
First test will be to see if I can remember all of them.
Choose which one you want to go for.
Maybe I'll tackle the blended finance question, and
That
it's
is,
just
yeah, go
one of many aspects. But I think that Joachim spoke well of the scarcity of concessionary resources, the scarcity of public funding in general, and therefore, from our standpoint, blended finance can only ever be, to use a simplistic image, the wheels on the side of the bike, right? Whenever a blended finance approach is applied, whether concessionary or not, we should have a good line of sight of how the market will pick it up and do without going forward. There's just not enough public funding to keep buying the market lunch. So that's the wide principle, I guess. On the TA front, so specifically at Mobilis, the way we look at it is, well, the use of public funding has to result in a public good. Helping issuers in particular, tackle the very specific challenges of public markets, we believe can be a public good if the experience is shared, and I'll get back to the importance of sharing. In terms of solutions, I'm not going to try and make a list of them, but perhaps looking purely from a mobilization angle, we're trying to create a market for transition assets, for other assets that are tackling different aspects of sustainable development. Market creation is not a new exercise at scale. So we should just remember the basic principles. 3 out of them are simplicity, which is linked to operational efficiency. There's no denying the complexity at the project level. I guess what that means is that the vast majority of investors can never get involved at the project level. So the role of MDBs as bridges is, I think, a great way to characterize it. But again, we have plenty of examples. Just one of them, if you think about, go back to the 90s and the advent of the ETFs, when State Street launched the SPIDER, the idea was about operational efficiency and an alternative to futures, and the rest is history. So packaging things in a way that is easily digestible by investors is absolutely key. Another one is standardization. Markets, again, love nothing more than doing the same thing again and again and again and again. Using another example, credit swaps, they existed for a while before Salomon Brothers famously did a multi-currency swap between the IBRD, funnily enough, and IBM in the 80s. But what they changed is they standardized the documentation, and that created an enormous growth path for the market. And then finally, and perhaps very importantly in the MDB context, transparency. Markets feed on data. We all know that. If MDBs are pioneers or bridge makers, the information that they gather, the lessons that they learn, that's all very useful. And I know it's a very boring conversation for those that have been having it for a very long time, but there is no market creation without access to historical data. And thankfully, we've gathered a lot over the years with taxpayer funding. So simplicity, standardization, transparency, I think we should look at ourselves and ask ourselves, are we all these things, or do we tend to be enjoying complexity a little bit too much, specifically when it comes to blended finance? Do we rely on bespoke models more than is necessary? And the opacity question, I'll leave there. New products, look, very quickly, I tend to find that there's not often a real need to reinvent a wheel in financial markets. There's a great array of tools that are capable of solving a number of issues, and maybe using old tools for new purposes is a good way to look at things. So using one example that, again, Joachim mentioned earlier, we think that in the concept of transition, securitization is a tool that should be used far more in developing countries, allowing banks, which are the other commercial banks, the other enormous pool of capital that we need to tap, to recycle that capital faster is absolutely key. Mobilis supported the latest Befron securitization that, of course, AIB is a partner of. And we think that needs to be scaled, that needs to be replicated across markets. There are other examples, but again, we know the recipes. It's just about remembering how to use them.
Yeah, no, thank you very much. We're starting to run out of time. There was a slightly challenging question which I wanted to put to our multilateral panelists, which was on MDBs essentially being accused of crowding out finance, and whether this is a fair critique, and whether we have any responses to this. Carsten, putting you on the spot, but do you have a response to that? Anything you'd like to?
So it's actually part of our mandate not to. Let me say this up front. This is part of our articles. We're not there to crowd out. I think it actually rarely happens. The markets that we are in, there's definitely in many of the larger markets there is, say, competition. There is funding available. But what we try to identify is really the areas where we are needed, and this often is the longer tenors. It's the patience with some of the projects to come together. It's the ability to combine products. We can invest equity, mezzanine, debt at the same time if needed. So I think typically we're more approached for to have, Leslie mentioned, he said we are bureaucratic. I would say we are quite diligent, and that diligent process is maybe requiring patience from our clients at first, but often appreciated afterwards, because we look at a lot of aspects of the business. And once sort of we have clients who come for that, basically get the IFC name in, so they can say, look, we've been sort of vetted by IFC. That's typically what we're more approached for. I rarely think of situations where we're actually crowding out. Occasionally we do compete amongst ourselves a little bit. That can happen if a project is particularly attractive, wouldn't negate that. But in principle, it's more of a cooperative approach amongst us. And I wouldn't say we compete with private sector banks.
Yeah, Leslie, please.
Just to be self-critical a little bit about our industry, I think that historically it has been possible that we have been perceived as crowding out. And this is just because of the pure fundamentals. As highly rated institutions, we have the lowest cost of capital, meaning when we go and raise bonds, it will be the cheapest because we are AAA and AA plus, etc. So when we add our spread and still make a very decent return, many private investors or institutions would not be able to match us because of our, we are in this unique class. We're the only remaining AAA institutions in the world in the financial sector. So because of the way in which our loan pricing historically have been applied, it was possible that some crowding out could have happened. But as Carsten have said, it is not, it is an explicit part of our mandates to be crowding in. So, and in every transaction now, because of as I said, the mobilization of capital has been elevated to the #1 objective. So when the deal comes to the Credit and Investment Committee, you have to demonstrate that you have used your catalytic power, that you have brought in other institutional investors, because we now publish, and IFC again should be credited for leading this. They don't just publish how many transactions they have done, but they actually publish and disclose how much capital have they mobilized. So you're not assessed as individuals when you do your annual performance assessment. Well, we've done so many transactions and deployed, X billion of capital. You are assessed on how much you have crowded in, which means that, you are disincentivized to crowd out.
Yeah, no, absolutely. For a final couple of minutes, there was a nice question about the experience that you all obviously have and some of the challenges that you faced on this journey, how you've overcome them, and kind of what you see going forward in the future. So maybe I can get your thoughts just as kind of wrapping up reflections on that. And Joachim, I'll go to you first.
I mean, I want to reflect on the overall sort of transition theme and sort of ask how can we accelerate this transition, and some other questions sort of relate to that. How do we deal with the dramatic climate crisis? The economist in me says, well, you just need to create a global mandatory carbon market, let the global political process set the targets and let things play out, and the problem would be solved. Now, of course, the reality is very, very far from that. And there are a huge amount of political and technical obstacles to that simplistic technocratic solution to the transition. And what I think we have to think about is how all the messy little steps we are individually taking in our spaces fit into that bigger picture, which I think will take several decades. But I think we should think about how the voluntary carbon markets, how the climate funds, how the blended finance mechanisms, all are sort of little mosaic pieces that, in the absence of the sort of grandiose solution, can move us in the same direction and get us closer to that outcome, so that when maybe in a few decades we have that globally integrated carbon market, that's a much easier step to take. So that's sort of just a final thought about how the many initiatives that we're working on need to fit together in a still, for the foreseeable future, very messy way. And I think we have to live with that.
Yeah, no, excellent point. I think, Leslie, over to you for final thoughts, and again, talking about some of the challenges you've experienced, how we overcome these, and what you see in the future.
I mean, I'd say, what is clearly required today to sort of guide this transition towards net zero are dedicated institutions focused on the climate agenda. And there's already people who argue, Nick Stern and others, Professor Nick Stern from London School of Economics, one of the leading sort of climate economists out there, arguing that you need dedicated climate banks, and MDBs are the best positioned to become climate banks, meaning that you almost exclude everything else and you use your entire muscle and balance sheet towards gearing the financial system towards transition finance. I think there's a strong case that can be made for that, but the proof is now in the pudding. We've got a clear sort of agenda of what needs to be done over the next number of years to try and scale blended finance, to scale transition bonds, to scale all these new financial instruments that have been identified that could be more effective in enhancing our work. So in short, I guess what I'm saying is that we are going through a transition. There will be transition pains during this process, but we are well positioned now to play a very different role into the future.
Yeah, thank you, Leslie. Carsten.
Yeah, so maybe I'm answering the lessons learned. So 2 thoughts on that, because we debated this internally quite a lot as well. I think a lesson learned is stick to what you're good at to some extent. Doesn't mean don't stretch yourself, but stick to what you're good at. We often had debates about, we have this really sexy little project which will have a super high development impact. Lesson learned was, if you look at the portfolio, it's the partnering with the experienced partners that have something before, and these are the ones to stretch to try to do new areas. The chances of success and the impact that you wanted to achieve is a lot higher. So that's a bit of a lesson learned where we are. Looking forward, picking up where Leslie was, in terms of climate, I don't think we will become a pure climate bank. We have other objectives as well, food security being one, a major theme, but exacerbated by what is happening in Ukraine. Most recently, building resilience in health, which is coming out of the pandemic, helping countries and domestic markets to build their own capacities is there. But climate features in all of them. While we do a lot of things that are solely geared towards climate, sustainability in loans, bonds, we're on the first blue loan here in Asia, green loans is a key theme. There's probably hardly any project where we do not look at the climate aspects. We set ourselves high targets in terms of what we call Paris aligned, so aligned with the Paris Agreement. All of our projects will move in this direction, so that will stay, clearly. Also, going back to what was being discussed at the annual meetings by our president of the World Bank Group, mobilization will be key. It's a clear recognition that we can't do this ourselves. Ultimately, the seed funding of all of our organizations comes from governments. There's a limited capacity, so crowding in the private sector, and sort of we've been, over the years, developing, since pretty much the IFC was created, mobilization programs geared at different partners, from banks to other DFIs to insurance companies, to see how we can bring in more. And as Leslie said, we are measuring how much we are bringing to the table versus others. And any expectation is we are trying to become more creative, more proactive in increasing the ratio of how much more we bring in from other partners.
Thank you. And Thomas, over to you.
Well, I think in our case, having come to development finance after long careers in capital markets, what really we have learned is that MDBs, DFIs have created incredible value. And we are extremely fortunate to have this development finance sector. Now, for it to deliver on its full potential, we also firmly believe that it needs to become far more integrated into the wider capital markets. 2 universities that have grown for very long and very often in parallel, it's not easy to drive that integration, and we think that is in part the role of governments as shareholders to push that and to bring actors together to deliver the fullness of that potential.
Thank you. Thank you so much to you all for joining me. Thank you to our audience. Clive, I'll pass back to you to introduce our final panel before we have our drinks. Thank you.